Hi, welcome back to the third video for chapter 7. Now I'm moving to the next slide, which is the balance sheet. Balance sheet is actually the statement to state how much your business worth, or how much is the value of your business. So in order to know how much is the business worth, so you will apply the formula in your balance sheet, which is assets. Asset means your total assets, fixed assets and also current assets. All assets value, you will minus all your liabilities. Liabilities means all your loans, all your debts, all your credits, all your borrowings that you make. Sometimes you have credits with your supplier, you have loans to the banks, you also borrow from your family members. So all your liabilities will be deducted from the total assets. Only then you know how much is your equity. Equity means your worth, how much value actually is yours. So balance sheet is the important statement because we want to know, do we have enough asset to pay all the liability, debts, credits and borrowings or not? If we don't have enough asset to pay all the liabilities, and we have zero capital or owner equities, then how we are going to pay all that? We will be in trouble if we don't have enough assets in order to pay all the liabilities. So it is an important statement that every restaurant owner should understand. So this is actually the formula. Next is the types of bank accounts that you should open for your restaurant business. Number one, you should have one separate account for your operation. In this, you will use to actually pay all your operational expenses. What is operational expenses? It can be like purchased products and also operational supplies. Operational supplies means your food, beverage and other supplies like packaging supplies, cleaning supplies, other purchases. Guys, next is to pay for the fixed cost of the month. So fixed cost of the month, example, this one is we call as escrow account. So escrow account will be used to pay all the fixed costs of the month. This one is not the operational purchases. Purchases for operation. This one is to pay all the fixed costs every month. For example, your rental is fixed every month, is fixed the rental amount. Next is insurance. Every month you have to pay the same insurance amount. Next is utilities. Guys, why utilities is fixed cost? You might be asking, utility cost, for example electricity and also water, will not be the same every month. It will depend on the sales. Guys, if you think really carefully, if there is any customer coming to your restaurant or there is no customer coming to your restaurant, either you have a lot of sales or you have lower sales, the aircon still need to switch on, the lights still need to switch on. You will need to pay the same amount of electricity throughout the month. It is basically the same. Next is you should have the third type of account, which is the payroll. Payroll means the account you will use to pay all the salary for your staff, the monthly salary of the staff. Next, we want to learn a little bit about how to prepare a budget. What is a budget? Budget is actually the plan for your future operation of restaurant business. Guys, when you prepare budget, actually you prepare budget for next year financial term. When you are presenting today the budget, actually you are presenting the next year operation plan. So how actually you write your budget? For your information, it is very easy to prepare a budget. Budget is prepared like how we write the profit and loss statement just now. Budgeting formula is the same like profit and loss statement formula. So I just repeat, what is profit and loss statement formula? It is actually sales minus cost equals to profit. So how is the budgeting formula? Next year's sales that you target minus next year cost that you think you will pay will be the next year profit that you target for. So that is how we prepare the budget. Actually, we prepare the income statement for next year. Next is the component of budget. Like I said just now, the component of budget is what we learn in the profit and loss statement. The same component. You should have sales, and then you should have cost, and you should find your profit. Sales minus cost is profit. However, here in this slide, they want to explain to you the different types of costs. In restaurant business, we usually consider we have two types of cost, the two major types of cost in any restaurant business. Number one is fixed cost, the cost that will not fluctuate, will not be changing with volume. Volume means sales volume. Either your sales is high or your sales is low, your fixed cost is the same. For example, your rental. For example, your loan that you pay to the bank, insurance that we have discussed just now. Variable cost, by the name you know, variable. Variable means it will fluctuate and will not be fixed. So this is actually dollar cost that is directly impacted by sales volume. If you are making more sales, then variable cost will be higher. Very simple example, if you are selling a lot of burgers, you will take out a lot of patty and buns from the storage, so the cost of food will increase. Guys, example of variable cost is cost of food and cost of beverages, because when you sell more food, the cost of food will increase. Next is combination cost. What is combination cost? Simply means is uh, fixed dollar or fixed cost plus your percentage of sales. Guys, what is variable cost? It is percentage of sales. Like we said just now, the variable cost will increase when sales are increased. So we call it percentage of sales. So what is combination cost? Combination cost is combination of two types. Number one, fixed cost, and also percentage of sales. Percentage of sales refers here, variable cost. Guys, I just repeat, combination cost is actually fixed cost plus your variable cost. Fixed cost of the month includes when you pay rental and also when you pay mortgage payment to the bank. Guys, when you buy certain assets, you will have like mortgage payments with the bank and you have to pay every month. Rental of the building also you will pay every month the same amount. Property tax, you will pay the tax every year the same amount. So tax of property means building tax. You will pay to the local authority every year the same amount. Whether your business is good or not good, you still have to pay tax. Next is insurance cost. Next is payroll. Guys, why payroll is fixed cost? You will pay the same amount of salary to your staff. Whether your business is good or not, you will pay the payroll same amount. The staff should get the same amount every month, but not including bonus. What is bonus? Bonus is when you have good sales, then you give bonus to the staff. Next is contracted maintenance, means scheduled maintenance, that you ask people to come to your property and do the maintenance. This one is scheduled every month or every 2 months or every 3 months, and it is contracted, and then you have to pay. Utilities we have discussed just now. You still need to use the electricity, you still need to use the water and so on, air conditioning and so on, whether your sales is good or not. So utilities is considered fixed cost. Next is loan payment. If you are applying loan from banks or other financial institution, you still have to pay the loan payment to the banks. And last one is equipment lease payment. This is what I said just now. Sometimes you will lease or rental equipment like coffee machine or other types of machine, and you will need to pay monthly to the supplier. Guys, I see you on the next video.